There is something about buying a house in America during the 1980s that people who lived through it remember with both pride and disbelief. The interest rates, the prices, the way a middle-class salary could actually afford a home. And if someone bought a house then, they know exactly what made that decade so different from today. This was a time when housing prices seemed high compared to the 1970s, but look absurdly cheap now. Interest rates reached levels that would be unthinkable today, hitting 18% and even higher. The American dream of homeownership was still accessible, but it required sacrifice. This was the decade that gave us mortgage rates above 15%, suburban sprawl reaching new heights, and the last generation that could buy a house on a single income without being wealthy. The housing market was volatile, shaped by recession in the early years and boom by the late 1980s. Let's walk through what it actually cost to buy a house during that unforgettable decade. Some of this might bring back memories. Some of it reveals just how much has changed in 40 years. Let's step into that world. The median home price in the United States in 1980 was around $64,600. That number sounds impossible now. In many American cities today, that would not even cover a down payment. But in 1980, that could buy an entire 3-bedroom house in a decent neighborhood. By 1989, that median price had climbed to approximately $120,000. The decade saw prices nearly double, which seemed dramatic at the time. Regional differences were significant. A house in the Midwest might cost $55,000, while the same house in California could run $120,000. New York and the Northeast were expensive, but not yet impossibly so. The South offered the most affordable housing. Texas, Florida, and Georgia had homes available for well under the national median. Young families could afford to buy. A house in suburban Dallas might cost $70,000. A ranch-style home in suburban Atlanta could be had for $65,000. These were real houses with yards, 3 bedrooms, 2 bathrooms, and garages. What made the 1980s unique was not just the prices, but the interest. When people talk about buying a house in the 1980s, they talk about the interest rates first. In 1981, mortgage rates peaked at over 18%. Some buyers faced rates of 18.5% or even higher. For perspective, a 30-year mortgage on a $65,000 house at 18% interest meant monthly payments of around $990, not including taxes and insurance. That same loan today at 7% interest would have monthly payments of around $430. The interest rates made housing expensive despite the lower purchase prices. Buyers in the early 1980s were paying far more in interest over the life of the loan than the actual cost of the house. A $65,000 house purchased with an 18% mortgage meant paying back over $350,000 over 30 years. The interest alone was more than 5 times the principal. The median household income in 1980 was approximately $21,000. By 1989, it had risen to about $32,000. This meant the median house in 1980 cost roughly 3 times the median household income. That ratio would gradually worsen, but in 1980, it was still manageable. A family earning $25,000 could realistically afford a $65,000 house, though the monthly payments at high interest rates would stretch the budget. Banks typically required that housing costs not exceed 28% of gross monthly income. With creative financing and 2-income households becoming more common, families made it work. Down payments in the 1980s were substantial. The standard was 20% down, which meant coming up with $13,000 on a $65,000 house. That was a significant sum. Many first-time buyers turned to family for help or saved for years to accumulate the down payment. Some used Federal Housing Administration loans, which required smaller down payments, sometimes as low as 3.5%, but these came with stricter requirements and additional costs. Veterans Administration loans offered 0 down payment options for qualifying veterans, and these were popular paths to homeownership. Adjustable rate mortgages became common in the 1980s as a way to make homes more affordable initially. These adjustable rate mortgages offered lower starting rates that would adjust over time. Many buyers took the risk, gambling that rates would drop or that their incomes would rise enough to cover increasing payments. The houses that Americans bought in the 1980s had a very specific character. Suburban developments were spreading across the country. The suburbs that had started in the 1950s and 1960s were maturing, and new suburbs were being built further from city centers. The typical house was a ranch or a split level. These homes usually had 1,200 to 1,800 square feet, which was considered adequate for a family. 3 bedrooms and 2 bathrooms were standard. The master bedroom was not yet a master suite. It was just a slightly larger bedroom, maybe with its own bathroom. Basements were common in the North and the Midwest. Finished basements added living space without adding to the square footage that determined property taxes. These basement rec rooms had wood paneling, drop ceilings, and carpet over concrete. Kitchens were smaller than modern kitchens. The eat-in kitchen with a small table was standard. A separate formal dining room was common, used for Sunday dinners and holidays. Countertops were laminate, often in earth tones or butcher block patterns. Cabinets were wood or wood grain laminate. Appliances were white or almond colored, built to last decades. The avocado green and harvest gold of the 1970s were fading, replaced by more neutral tones as the decade progressed. Living rooms had wall-to-wall carpeting, often in beige or light brown. The carpets were thick and felt luxurious. Popcorn ceilings were everywhere, applied because they were cheap and hid imperfections. These textured ceilings would later become something everyone wanted to remove, but in the 1980s they were standard. Before we continue with how the housing market changed through the decade, if you are enjoying this look at housing costs and want to explore more about how Americans lived in different eras, consider subscribing. There are so many more stories about the economics and daily life that shaped the country we know today. The early 1980s were difficult for the housing market. The recession from 1981 to 1982 hit hard, and unemployment rose above 10%. The Federal Reserve under Paul Volcker raised interest rates dramatically to combat inflation. That made borrowing expensive, and it slowed the economy. Housing construction slowed significantly. Existing homeowners who had locked in lower rates in the 1970s were reluctant to sell because buying a new house meant accepting punishing interest rates. The market was frozen in many areas. Sellers struggled to find buyers who could afford the monthly payments at 16 or 17% interest. Some sellers offered creative financing, carrying mortgages themselves at lower rates to make deals possible. This was risky, but sometimes the only way to sell. Lease-to-own arrangements became more common as buyers and sellers tried to work around the interest rate problem. By the mid-1980s, things began to improve. Interest rates started declining from their peaks. By 1985, rates had dropped to around 12%, which felt like a relief. By 1987, rates were in the 10 to 11% range, and by 1989, they had fallen to around 10%. As rates dropped, housing became more affordable and the market heated up. Housing starts increased and construction workers were busy again. Suburban sprawl accelerated as affordable land further from city centers was developed. The baby boomers, the largest generation in American history, were in their peak home buying years during the 1980s. This demographic pressure drove demand. Specific markets saw dramatic changes. California housing was already expensive and getting more so. The median home price in Los Angeles in 1980 was around $100,000. By 1989, it had climbed to over $200,000. The San Francisco Bay Area was even more expensive. A modest house in Silicon Valley could cost $150,000 in 1980 and $300,000 by 1989. The technology industry was creating wealth and driving prices up. New York City and the surrounding suburbs were expensive throughout the decade. A house in suburban Westchester County might cost $150,000 in the early 1980s and $250,000 by the end of the decade. Manhattan co-ops and condos were for the wealthy only. Boston followed a similar pattern, with prices rising steadily. The affordable markets were in the Rust Belt and parts of the South. Detroit housing was cheap because the auto industry was struggling. Entire neighborhoods had houses selling for under $30,000. Cleveland, Pittsburgh and Buffalo had depressed housing markets. Manufacturing decline meant people were leaving, not arriving. The Sunbelt was growing rapidly. Phoenix, Las Vegas, and Albuquerque offered affordable housing in warm weather. Retirees and young families both were attracted to these cities. Florida was booming with both retirees and young professionals. Miami, Tampa, and Orlando all saw significant growth. Housing was relatively affordable, though prices were rising. Texas experienced an oil boom in the early 1980s, then a bust in the mid-1980s. Houston housing prices rose dramatically, then fell sharply when oil prices collapsed. Some people who had bought at the peak lost their homes when the market crashed. The savings and loan crisis of the late 1980s affected housing markets across the country. Hundreds of savings and loan institutions failed after making risky loans. The government had to bail out the industry. Real estate speculation had driven up prices in some markets, and when the bubble burst, prices fell. What defined buying a house in 1980s America was that it was still achievable for middle-class families, but it required sacrifice. High interest rates meant large monthly payments. Families adjusted their budgets, cut expenses, and made it work. Having a mortgage payment that consumed a large portion of monthly income was normal. The assumption was that incomes would rise over time, making the payment easier to manage. That assumption generally proved correct for those who kept their jobs. The tax benefits of homeownership were significant. Mortgage interest was fully deductible, which reduced the actual cost of ownership. This tax break made buying more attractive than renting for many families. The pride of homeownership was still central to the American dream. Owning a house meant stability, building equity, and providing for a family. Looking back, the housing costs of the 1980s seem absurdly low, but the interest rates were crushingly high. The generation that bought houses then endured years of high monthly payments, but they also built equity in homes that would increase in value dramatically over the following decades. Many of those $65,000 houses purchased in 1980 are now worth $400,000 or more, depending on location. The buyers who struggled through 18% interest rates in 1981 eventually refinanced when rates dropped, unlocking significant savings. Those who held on to their homes through the decades saw remarkable returns on their investment. For those with memories of buying a house in the 1980s, the combination of low prices and high interest created a unique moment in American economic history. For those exploring what life was really like in different eras, there is always more history to uncover.